SaaS Model. Let's take a look at the components of CFI's SaaS model. It has the key business assumptions that are required to drive the model. Then it has a traditional three-statement model built onto it. It also has supporting schedules that are required, such as fixed assets and debt. It includes customer metrics, which are very important for evaluating a SaaS business. It has a valuation section where we can determine what it's worth with a net present value calculation. The purpose of the SaaS model could be many different things. One is to assess the economics of a SaaS business. Another is to determine if a new business idea is viable. This could be used for a startup. It's used for internal budgeting and planning purposes if you are at the operation of a SaaS company. The relevant courses are Building a Financial Model in Excel, Business Valuation, and the closest course we have to actually building this model step by step is the e-commerce course. We don't currently have a full SaaS course, but by taking these other courses and working with a completed model, you should be able to figure out how to build it yourself from scratch. Let's take a look inside the model now. Here we are inside the SaaS model. Let's take a look first at the monthly schedule. This model starts with monthly assumptions. The key critical assumptions for this model are the customer churn rate, the average months that are paid up front when a new customer signs up, the renewal rate, and the average revenue per account. Once we have those things, and then below that, we can, for each year, do a monthly build-up. So you start with the number of customer accounts, you add new customers, and you subtract the churns. Then you take the monthly recurring revenue, add the new ones, subtract the churned ones, and you get the net monthly recurring revenue. There are also assumptions here about the churn rate and expansion on a monthly basis. As you can see, if we open everything up, this process is repeated for each year. That way, you can have the monthly detail, which is very important for a SaaS company. And then, if we flip over to the actual financial model, we can roll it up to get the annual numbers. So let's open up all sections here. These green cells are referring to other sheets in the model. The blue cells are hard codes, and the black cells are formulas that refer to this worksheet. So you can see that we're bringing forward some of this information that's in green from the monthly schedule. Then we have a few more assumptions about the average bill size, about the percent of revenue from subscription versus the percent of professional services and other revenue. Sales and marketing expenses, research and development, G&A expenses, as well as balance sheet items here. And all of that then feeds into an income statement, a balance sheet, and a cash flow statement. We also have supporting schedules for depreciation and amortization. And then we get some customer metrics. So we get the monthly recurring revenue churn rate, lifetime value, customer acquisition cost, and the ratio of LTV to CAC. Let's also look at the months it takes to recover a customer acquisition cost. This is a very important metric. Finally, we have a valuation section where we actually calculate the enterprise value and equity value of the business. And beneath that, we have some sensitivity analysis that shows the enterprise value using different weighted average costs of capital and different terminal value multiples. So as you can see, this is a very detailed and robust SaaS model that has both annual information on the full-blown model section and a monthly schedule that feeds into it.